Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. The last several weeks have been incredibly challenging for investors. Not only have we had two of the largest three bank failures in U.S. history, we also had the Federal Reserve raise interest rates for the 9th time during this tightening cycle. In 34 years of investing money for clients, I'm not sure I've ever said bank failure and the Federal Reserve raising interest rates in the same sentence. That's truly how rare this time period is right now. That clearly has created volatility in the markets, and we see it not only in the equity market, but also the fixed income market. My first graph today will show you that. At the top, we have the equity volatility. As you can see, it has come up modestly during this time period. To be honest, it's within normal ranges, and you can see that the equity market isn't per se concerned about what has happened recently. Where we've seen a dramatic difference has been in interest rates. The next chart shows the MOVE index, which measures the 10-year Treasury volatility, is increased 80% during this time. That's near record highs, numbers that we saw in 2008 during the Great Recession. Truly, again, a very rare time where we have interest rate volatility being higher than equity volatility. Even given all of this volatility, the good news is that a typical equity portfolio of 60% stocks and 40% bonds is relatively unchanged since March 8th, the day before the news on Silicon Valley Bank broke. And year to date, it is actually up, which is a significant improvement from what happened to that typical portfolio in 2022. As we move on to the Federal Reserve, as I mentioned earlier, they did raise interest rates a quarter point in the last week. This is the 9th rate increase. And you'll see that in the next graphic. The next graphic shows how steep that increase has been over the last 12 months. And comparing that to any time since the early 1980s, it is the highest rate increase and also the fastest rate increase. Now, I'm sure there's a few historians that will want to watch this video and go, hey, Paul, you're forgetting the late 1970s and 1980 when Chairman Volcker raised rates at a higher rate. The answer is true, but since he defeated inflation in the early 1980s, this is truly the most aggressive Fed response that we have seen. Now, post that announcement, Chairman Powell also came out and talked about the impact of the last couple weeks, specifically that he believes that this will likely make lending activity slower and possibly slow the economy as well going forward. If both of those happen, it will help alleviate two concerns the Federal Reserve has. First, it should ease inflation further, and then second, it should ease employment numbers. If both of those were to occur in the coming months, we likely have seen the Federal Reserve either finish raising interest rates or might have one more rate increase. Either way, that should be good news for the investment markets. We also know that the volatility that we've experienced over the last couple weeks tends to be short-lived. In the next couple weeks or months, we will quickly move on to what's happening into the economy, where we think interest rates are going, and how corporate earnings are doing. Those are the three things that drive valuations for equities going forward. As always, thank you for the opportunity to serve you and your family, and have a great day.